So, welcome to another episode of Tuesday Talks with Dan and Harris. So, Dan,
Hey, what's going on? Hey, Harris, how you doing today on a Tuesday afternoon?
I'm doing all right. How are you doing, man?
Hey, pretty good, pretty good. Looks like my makeup isn't done here, but let's jump into it. I mean, I think our first one we shot was pretty good. We touched on a lot of good points there, and uh, yeah, today, what are we talking about,
Well, I,
Harris?
I wanted to talk about first-time home buyers. I think that's like incredibly important, especially with like kind of
Mm,
the climate today, with what's going on with real estate. Figure would go over a little bit about the process, what they should be thinking about, um, and yeah, well, like how can they navigate through this thing? And I think um, you're in a better position to speak about this than I am, because I think you see that those issues firsthand. You're the one who kind of helps people figure out their financing and all of that.
right.
So it's kind of I think one thing that I see, at least with the first time home buyers that come through Treadstone Law, is that they're always kind of confused and they don't know what to expect next. And I don't think there's anyone there that kind of tells them from beginning to end what to expect at the next stage. So they're always kind of like, oh my God, I don't know how to do
Yeah, yeah,
this.
yeah. Yeah, oh man, it can if you're in the market for the first time or it's been a long time since you've purchased, it can be so overwhelming. I
Mm.
mean, there's just so many different things you have to kind of juggle. That yeah, I see this a lot. So I'm glad we're talking about this today, because as we kind of hit the ground in 2022, we're going to see a lot of folks getting out there trying to get into the market, and I think FOMO. Could be part of that, but regardless of what their reason is to get into home ownership, um, yeah, this is a good subject to touch on. I actually did. I'm gonna plug my channel again, but I ended up doing a video on sort of like a first time home buyer, everything you need to know, 101
Yeah.
basics. So it's kind of fresh in my mind too. And you're right, like a lot of clients that come in uh, as we're kind of running through uh, their application. And so there's so many questions, so many things to cover, and government programs and things in the news. So let's jump
Yeah.
into it. I'm
So
excited
I
about
guess the
this one.
first question would be, if you're a first time home buyer, and you're maybe 6 months out to actually actively buying, what are the
Right.
financial questions that first time home buyers should be asking themselves?
Yeah. And I think before anything, the fun part in the entire process, if there's going to be any part that's fun, would obviously be the shopping,
Yeah, yeah.
right? Everyone loves shopping, but before you shop, it's good to have a grocery list. It's good to have
Mm,
a budget, a plan. So, in this case, 6 months out, it's probably a good idea to kind of do a financial check to see where everything's at, because um, sometimes things come out that you're not expecting or not anticipating. Maybe there's changes in underwriting guidelines or anything like that. But yeah, a good idea. 6 months out, I would say speak to a broker or your bank rep, whoever you're talking to, but get it manually underwritten, right? So I've seen clients where they just go online
yeah,
and they'll put it in a calculator and they put all their faith and the largest purchase they'll probably make in a very
yeah,
long time in a calculator. That's it's great for sort of just a quick test, like a rapid test on it, to say, okay, well, is it even feasible? But it's always a good idea to get someone to actually review income, figure out down payment if there are going to be any issues with where the down payment's coming from, and then just kind of come up with a strategy. So at least you have a starting point and you're not wasting your time, right? Because a lot of this is like, especially in this market, I'm sure you've seen it too, where something comes on the market, you got to act real quick and get your offer ready and submit it. So you definitely don't want to delay and having to do this. In fact, I'll tell you a little story. There was a client of mine, and they reached out to me because they were at their branch level. they put an offer on a property that it's not exactly a desirable property from a bank's perspective. One of the reasons is it has sort of an ancillary building that's on the property. It's larger, so 6 acres. So anyone out there that's listening, if you see like a hobby farm or you see something that's got a lot of acreage on it, oftentimes banks, it's not considered sort of prime real estate for them, right? So some issues there. Client had gone in, they put an offer. They had, I guess, worried that this opportunity was going to pass them by, so they went in without any conditions. And this is sort of a concern here. And we'll touch on this too, but
Mm-hmm.
no conditions. They cranked up their deposit on the offer, so they actually put, I think, like 150,000 on property that's worth about 700 or 800,000. They put a substantial
Yeah.
deposit.
Wait, so was
Um,
this property solely like a hobby farm, or was there like a house there, or did they want to
oh
change
no, no, no,
and put a house on the property?
no. So there's a house, but it gets even better. The house is, I mean, that's the least of their problems. But the house, I think it was used by the workers that worked on this property, but it was a commercial cannabis farm. So
Nice.
they had and as we know, in this industry, there are certain professions and there are certain industries uh, that banks kind of have a harder time providing financing on. And in the past, it was grow ops. So if a property was identified as being a previous grow op, even if it was remediated, a lot of banks would kind of turn that down. In this case, cannabis production also kind of like a hard stop for a lot of lenders. Anyway, they went in firm, and yeah, their folks at the branch were like, we can't do this. Go talk to a broker, see if you can get some alternative financing. So it can be really tough because you want to, by all accounts, you think this is a great property, but if you haven't sort of passed it by someone before you get to the point of putting the offer, and it can cost you a heck of a lot more, right? And you could probably speak of this on an actual offer. I'm sure you've seen offers that have been drafted where maybe they back out or they can't close. Like what happens in that case with a deposit? I mean,
Deposit gets actually messy. So if they don't like close, typically a lot of people kind of feel like, oh yeah, the seller can keep the deposit. I mean, they can't really, but the buyer does have to sue them, and then the seller can claim
mm,
all damages. So they can claim damages on the time they wasted, other extra expenditure to resell and remarket the property. So you do have to make them whole. But I mean, there's two things that I want to kind of touch upon with what you just said. You said basically to start off, um, go and get a pre-approval, right? Whether it's from the bank or it's from a mortgage broker. What I've seen is banks don't necessarily give out pre-approvals. They say that you need to have an offer,
mm,
and oftentimes that's a bit too late, right? You want,
right,
like,
yeah,
I personally feel like the prudent thing to do is you're getting actually approved twice, right? And when I say twice, it's like first you have to get approved, and then your property has to get approved. But if you don't have the property, get yourself approved, and the broker is in the best situation to see what's happening. Also, because with a bank, you're only going to one bank, and most banks even aren't looking at you. But if they do look at you on a pre-approval, you're only looking at what they're willing to offer you. Whereas a broker
mm,
has several different kind of options, and it's best to build that relationship out early because um, what I find is like if you're going in firm, which a lot of people are doing, even though I don't advise it, you want to have you don't want to be scrambling last minute to be like, oh snap, now I need to find somebody and understand them and get to know them and build that trust, and they can understand my financial situation so that they can go to several different banks. Because with brokers, the thing is like, and I'm sure you could speak to this more than I can, where you've got like relationships that you've built with banks and business development managers that you're not going to necessarily just throw at somebody just coming in last minute, and you feel like this person's not serious. So you want that
mm,
serious there because they're also the thing with a borrower or first time home buyers, like you don't have any trust. bank doesn't trust you. They'll look at your credit score, but when you're going with a broker, you're working off of the broker's trust too with the lender to secure you a loan to say, hey, I know this guy.
100%. Yeah, yeah, and then that's exactly it, right? You're kind of leveraging our
Yeah,
relationship in order to kind of get preferential treatment. So it's so important. And one of the things you had mentioned too is like if you last minute kind of say, all right, I gotta, I'm gonna hit up a broker. Well, optically, what that does is if I'm now representing you, going to a lender and saying, hey, this person's closing in 2 weeks or in a week. And the first thing is, well, why are they taking, like, what happened here?
yeah,
Let's look at this story. Let's unpackage it. And it's never, first impressions are really important. So, and yeah, the other thing you touched on with approvals, which can get a little confusing, right? Because you think, okay, well, I've talked to my bank, I'm approved. You're not really
yeah,
approved. I mean, it's a pre approval. I like to call it like a pre positioning because you're kind of reviewing the client, you're going through all of the questions, you're determining the debt ratios. But the one component we don't have, that unknown, the X factor, is the house. And the house, we're not going to know until obviously an offer's been accepted. At that point, if you've gone in completely firm on an offer, well, what happens? The question is, what happens if there's issues with the house? And both you and I have
yeah,
seen, files come across their desk where there's now a problem with the home, and yeah, so there's a few different things there that as first time home buyers totally get it becomes a little confusing. So I would say if you're 6 months out, go for pre-positioning, which is basically a review of your financials. Make sure your down payment, we at least know where it's coming from, where your debt ratios are based on today's sort of
yeah,
stress test. And then from there, you can kind of, what I usually do uh, is just make sure that I'm still in contact with, because we're putting together an A team, right? And I don't think anyone really in this type of environment, you need to have your team talking.
yeah,
And it's a group effort here. So solicitor, broker, realtor, we should all be on the same page because we're working towards closing for the
yeah,
client, right? So what I usually do is, okay, let's say, for example, if it's a condominium, right, there's something called a status certificate that you probably seen hundreds, if not thousands, to review.
yeah,
And for anyone that's listening or watching this, status certificates, um, that determines sort of the health of a condo corporation, and condos and townhomes that have corporations, and they have to be reviewed. So it's just, if you have a good relationship with the broker and the realtor and the solicitor, I mean, it's pretty quick. You can flip that over, have it reviewed before maybe putting an offer in, or if you've got a financing condition, to make sure that it's reviewed prior to signing off on it. There's so many reasons why you want to have everyone on the same page, um, but at that point, once you've got a pre sort of approval or pre-qualification, what I do is I just say, look, get your realtor, and when you guys are shopping, just flip over any listing that pops out or you guys are considering putting an offer in, right? Because then we can kind of run sort of a test on it, put it into the application, see if there's anything that pops out, especially downtown Toronto with condominiums, right?
yeah,
Because there's some of them that have, you've seen developer liens that go on entire condo corps, and that becomes very tricky to find financing. So if you can kind of send that over, and say, oh, why is this so low, or this seems like it's below market value, like what's going on here? Oftentimes we've seen it. So yeah, good practice to do.
yeah. And I've seen a lot of like people, first time home buyers. I mean, not first time home buyers and just regular. It could be their second or third house. Who will
Yeah,
throw in an offer and they'll go in firm or whatever, and they're not really touching base with everybody. They're just kind of saying, "Okay, I want this." And then when something goes wrong, they're like trying to back out. And I'm like, well, I mean, did you speak to me when you were getting into the agreement? And now that it's firm, you're asking me to find a way out. Like, that's like certain
yeah,
things you can't reverse. And so, and not even just that, I feel like as the market's getting tighter, there's a lot of, I would say, unattractive properties that hit the market that are taking advantage of that. And when I say unattractive properties, I've seen people throw in offers in properties that would not be insured because of floodplains, and now you have issues there, right? Or
Right.
it looks really nice until you realize it's like a heritage home, right? Heritage site that can't be
Mm.
changed. Or you're thinking of buying the house because it has a farm on it and possibly putting a house on it, but then you realize it's part of like a conservation authority, and you gotta like really that it's expensive
Mm.
to even think about changing the zoning. Forget about like confirming or guaranteeing any kind of outcome, right? Even the attempt is expensive.
Right.
So,
Right.
and a
Yeah.
lot I've seen home buyers kind of play with the idea of putting in an offer in these properties, and then realizing like, okay, well, I can't. I'm like, my thing is like, if you want to do a zoning change, it's going to cost anywhere between 5 to 20,000. I can't tell you what it is, right? I'm gonna have to look at the property. We have to look at what authorities have jurisdiction. We have to look at a lot of things. So understanding your boundaries, understanding your lane is extremely, extremely important. And that starts 6 months where you're kind of doing that research to make sure that firstly, you know what your affordability is, you know what type of house you need, you know what you can't get, right? All these things are kind of understood. And also because when you then, I feel like the buying season for a lot of people is not long. It's on the shorter end. You probably want to buy during the summer. You don't want to move during the winter, right? And a lot of people want to sell their property during the summer as well. So you want to make sure that you've got all your ducks in a row, so that when the time comes, you can make that offer and get the house, instead of trying to figure things out and then the season is gone. So
Right.
that's the other
Yeah.
thing.
Yeah. And it's kind of unfortunate when, you have to have that conversation with someone where they've come to you, sort of after the fact to do damage
Yeah.
control or to get them out of a sticky situation.
Mm.
It's never, it's never an easy thing to navigate. So definitely good points there to kind of keep an eye on. And uh, yeah, when you're out there shopping. Um, Harris, you've probably heard of the first time homebuyer incentive program. Um,
Yeah, I've heard of. Yeah, it's
you've heard
yeah.
of it?
There was.
Yeah.
I don't know if it was really popular, but I've heard of it. Yeah.
Yeah, yeah. And so for anyone that's out there that hasn't heard of it, it's an incentive program that was, I think it launched what, maybe a year and a half, maybe 2 years
Mm.
ago. It's been a while, but there was a lot of talk of this helping first-time home buyers get into the market. And obviously, we have supply issues. We have other issues that are definitely driving up the cost of real estate. But this was meant to really help as a program. Now, it came out with a lot of mixed reviews. And to be honest, personally, I have not had one client come to me. I mean, I've had a few come to me asking about the program, but ultimately not going with the program. I think it's kind of fallen short. The program essentially allows you. I think the household income cannot exceed $120,000. So that's sort of the threshold, or the point where, if it exceeds that, you're not eligible for. I think it's the GTA and the Greater Vancouver area. They've announced that it goes up to 150,000. So what that essentially means is the household income in those markets can be a little bit higher, but your purchasing power is like 4 times. I mean, you can find this out on the CMHC website, but overall, they'll provide anywhere from 5 to 10% of a down payment in a property where it's insured. So that an insured mortgage, for anyone out there, is a mortgage where you're putting less than 20% down on a purchase. Um, you have to obtain mortgage insurance. The mortgage insurance in Canada is provided by 3 insurers, and essentially that insurance is just added into your mortgage, your principal and interest payment, and then amortized over the length of the loan. So caps at 25 years of amortization, and then it's a percentage based on the overall loan to value. So if you haven't heard of the term LTV, that's loan to value. Um, depending on how much you put down, that'll determine how much mortgage premium insurance you're paying. So government comes along and says, okay, well, we'll do 5 to 10%, depending if it's a new build or if it's an existing build. The thing I don't like, and a lot of people don't like about the program, and I'm not trying to knock it too much, but it's taking advantage of the upside of the market and how much it's been increasing. So they actually have equity ownership, a percentage. So they share in the upside, and they say they share in the downside, right? So if there's a massive market correction, they're also at risk there too. But I don't know. I mean, what's your opinion on it?
Well,
Do you think
so
that?
I don't know too much of it about it because literally nobody has uh,
Yeah.
come through our firm that's used that. But my question is they're only taking a percentage of so if they're putting down half of your down payment, that ownership stake remains the same. So I'm assuming that, like, let's say the house is worth 100,000, and they put 10,000 down, they own 10% of the property.
That's correct.
Hypothetical,
Yeah, yeah. So
exaggerated numbers, it's not going to come to 10%.
yeah,
But
yeah.
so if it goes up or down, they're never going to ask you at any point um, to take it back, or can you buy them out?
Yeah, so it's fully open to prepayment, so you can pay it out at any time, from my understanding. But yeah, it's kind of wild. So let's say, right, let's use that $100,000. I don't know where the heck you're buying for $100,000, but let's just say you bought a house for a
My
hundred
toilet
thousand
is
dollars,
on sale for 10,000.
right? You bought a garden shed
Yeah,
for $100,000 out in a on a hobby farm. Anyway,
yeah,
so $100,000, banks are you've got 5% down, and remember, it can't exceed 20% down because then it's not insured. So you've got 5%. Government's going to come in and they're going to say we're going to put, and it's a new build. So a new build, they'll do up to 10%. So they're going to put 10% in. You have 5%, they have 10. That's 15% down, still insured, right? So that 10% they just put down, or $10,000, let's say, over the course of, I believe you have to actually, so it's only for owner occupied. So you got to live in the
yeah.
house. And I think you have to stay in it for something like 4 years. Otherwise, if you sell earlier, there's some sort of penalty, or I have to look into it a little bit more. But let's just say you hold on to it for, let's say, 5 years.
Yeah.
And that $100,000 property now is appreciated to 200,000, right? That 10% now is 20,000 bucks that they take right off the top of your appreciation. I mean, it kind of, I don't know. It's a program that once you explain it to a lot of clients, they're just like, you know what? We'll pay the little bit more in mortgage insurance premium. And typically, when you do the debt ratios and the calculations for people, it really doesn't help them too much in affording more
Yeah.
property, right? So it's like now the government's owning, the bank owns your property, the government owns your property, you own a little bit of it, but it hasn't helped you get into a larger house. So I don't know. It's
Something about
not
it
very
rubs me the
popular,
wrong way too. I wouldn't want the government owning my house. That's just like,
right?
I don't know. But how for the for any was it high ratio mortgages? What's the minimum amount of down payment a buyer needs to put in?
That's a good question. Actually, I'm glad we're talking about this. So we have sort of a sliding scale, right? So the maximum amount for any insured mortgage right now, and there's talks of it obviously increasing just because the cost of property now is just kind of ballooned, but it tops out at a million less a dollar. So 999,999. It's got to be under $1 million, the purchase price. I actually have another client who he bought a pre-construction, a fantastic client, can easily debt service it, doctor. Problem is the pre-construction purchase price after he added on a whole bunch of additional, so he bought it for like let's say 960.
Yeah.
Add in another $50,000 in upgrades. That pushes the purchase price over $1 million. Now he's not eligible for that 5% or that insured mortgage with the minimum down payment. You go basically from your minimum under $1 million. As soon as you're over $1 million, it's 20% instantly,
So you
right?
can't you
So
can't like, let's say you're buying a property for 1.1 million. You can't put down the 100,000 and then insure the rest of the million.
yeah, I mean, if it's with a developer, that's a really good question. That Probably have to call and find out with CMHC and one of the banks, because you could maybe prepay, have an adjustment on
Yeah,
the purchase agreement for a lower price, and then run it that way. That is an option. Um, yeah, I just have to see how banks
I guess it's
would
also a case by
classify that.
case scenario as well, right? So it's like looking
Yeah,
at the
yeah,
financial
because
position.
you have to have the
Yeah,
money to pay
yeah,
for all those out of pocket. But essentially, so in the first 500,000, it's 5% down. So that's 25,000 minimum down payment. And then anything in excess of 500,000 is 10%. So let's say you had a purchase price of 750,000. So the first 500,000 is 25,000, so 5%. And then the extra 250,000, that bumps up to 10%. So that's another 25,000. So 50,000 is your minimum down payment on a $750,000 purchase. Um, and yeah, that's kind of how it works. Now, the interesting thing when you're doing insured mortgages, and a lot of first-time home buyers, they want to take advantage of putting less down, right? Because in this type of market, I mean, if you think about it, 20% down on an average home price in the GTA of what, 800,000 or something
yeah.
crazy, or maybe it's condos that are like eight, $160,000. How long does it take two people working full time to save up that type of money? I mean, it's a lot of money, right? So, um, yeah, for insured mortgages, which is uh, quite a few first-time home buyers take advantage of the program. The debt ratio, so you have your two ratios. I'm not going to get too technical on this,
Yeah.
but there's basically gross debt service, total debt service. Those two, and it's a percentage of your overall household income. Those ratios are like pretty much set in stone. You go on CMHC, you go on Sagen or Canada Guarantee, the three insurers. If you go on the websites, you'll see their limits on what your GDS and TDS can be. You can easily uh, calculate this online, or if you want to go old school and use a pen and paper, you can also calculate your GDS and TDS. Actually, that's a good idea for like a video in the future. I can kind of
Yeah.
walk people through it manually, but
Or I mean, to
it
be
can't be
honest, man,
exceeded.
like if I'm a first time home buyer or a 10-time home buyer, I'd still go to a broker and be like, all right, like I don't. There's certain
I
things,
don't want to deal
yeah,
with
because
this. Yeah,
I mean, why do you need to figure this out, right? Like it's like there's
yeah,
always going to be that uncertainty whether you did it right or wrong. So I'd rather just go to a professional and be like, all right, just help me
yeah,
out.
yeah, 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 yeah. Yeah. Well, it's kind of, I mean, I guess it's a good exercise if you plan on buying a lot, or you just want to kind of understand sort of
Yeah.
the mechanics behind it. It's funny. It reminds me of like, so in flight school, I've done my flight training for my personal, my PPL, and we have to learn how to use a flight calculator. And if you've looked online, you'll see this big sort of calculator thing that um, it's so manual, and it's just a big hunk of metal to determine a ton of different calculations that easily could be done with a program.
Yeah.
So there's a program called ForeFlight that a lot of pilots use, and I mean, there's no reason to do it, but some people want to understand sort of, well, how do you manually calculate all of this stuff? So anyway, it's the same sort of thing. You can calculate it, or you can just get a broker to do it, which is way easier to do. But those ratios can't be exceeded. So regardless of what bank you go to, if you're getting an insured mortgage, um, the bank has to get sort of the blessing or the approval from the insurer, and there's no sort of gray area there. It's either a go or no.
Yeah. I feel like when it's a
So
high ratio, the bank kind of takes a back seat. Like the insurer kind of calls
yeah,
the shots, and if
yeah,
they insure you, you're good, and if they don't, then the bank doesn't care. Like they're not going to give you anything.
yeah, 100%. Yeah, and sometimes too, like in a certain circumstances, some banks don't work with certain insurers. They might just say, okay, well, we do all of our insurance,
Yeah.
our high ratio mortgages through CMHC or Sagen, or we might have access to two, or we might just do Canada Guarantee, and they have different programs. I think I touched this on the last uh, our last episode, but I talked about the low doc program, low doc advantage, I think, with Sagen, or not Sagen, Canada Guarantee. So this program, you have to. It's a little tricky because you have to find. So certain clients, they're perfect for it, and they won't fit any other program, but it helps them get into a high ratio mortgage, right? So but then you have to find a bank that's actually using that insurer. So it's a lot of like
Yeah.
calling the insurer first and then calling the bank and saying, do you actually work with this insurer? And then, once you kind of put those pieces together, then you can go ahead and then submit for an approval. But
Yeah.
yeah,
Just
that's,
goes to show, there's like a lot of brokers have a lot of different products. Again, like again, it's a lot of valuable information that you're given, but for me, again, I'm more of like um, go to a professional, get it done,
yeah,
right? Because
yeah,
it's like you're looking at this every day, right? And to some extent, like I'm in the periphery of this, right? I see it because we're working with the lenders and all of them to fund deals, and they get paid, like the actual legal side of it, where they're paying the mortgage on the other side. We're working with the banks for any conditions, so we get to see some of it, but we don't really see the financial side of how it got to our desk. And
mm,
even
mm,
with me having some kind of exposure to it, I would say it gets overwhelming with the amount of products and the way you'd have to qualify for different things. Where it's like I'd rather just kind of go to a professional and say, okay, here you go. Just like
right.
here's my situation. What can I afford, and like what's the best way to proceed, right? Um,
Yeah. Oh man, like, yeah, 100%. Like when I was prior to doing the brokering, right? I mean, you remember me in my days, even after we worked at Mercedes Benz together. We were like, you branched off, you did your own thing, um, and then I did the my own thing, which involved owning a tea company and then running that kombucha bar and doing sort of small business stuff. Man, I was so preoccupied, like most first time home buyers. You're occupied with your day to day, and you're just like, kind of like, can I hand this stuff to someone to
yeah,
get it done? And that's how I got sort of introduced to the world of mortgage brokering, because my local bank at the time, they just didn't want to talk to me. They're like, no man, like, you're an entrepreneur,
yeah.
you're pretty much one step away from being homeless. So let's
I mean,
yeah,
handing this stuff, I would kind of disagree with handing it off. I would say, like, for example, you go to a doctor, you don't hand your health to like the doctor, right? Like you have to, because they
yeah,
know
yeah,
your
yeah,
stuff, right? They know
yeah,
every single update that's happening. They don't when things are changing. They know like what's happening in the field of medicine, and you're going to go and trust them, right? And you're going to basically let them decide, because I don't know how, even though my body is very like an intimate part of me, I still
yeah,
don't know
yeah.
what the heck's going on
Kind of need
inside,
it.
right? So I'm gonna go to a doctor. Same thing with, I feel
Right.
like, but with professionals, with mortgages, I don't feel like it because of the current climate, it's no longer like here's your interest rate and then it's gonna amortize over 25 years and you're gonna pay this much amount. Like there's so many different products, right? That it's limitless. There's products where I've seen again, high ratio, low ratio. You're looking at products where different insurers have different things. There's also products where I don't know if this is even applicable here, but like you have a huge portion that's a credit line, the other portion's like a smaller portion that's a mortgage, right? You can pay it down faster. What about portability? What about like there's all these other things. What if I want to like pay down? How much can I pay down? Uh, Early every year. Like there's so many things that are involved
Right.
that it
Yeah.
gets
Yeah.
extremely difficult. At least for me, it's like very overwhelming with all the moving parts to figure out what options I have and like what I should be looking at. And I feel like that's where the
Yeah.
professionals like kind of like, okay, you know what? Like I know your back may be hurting. This is okay. This is perfect, right? Sometimes, right, when people have back, when you have your back hurting, and this is what I've kind of found out recently, right? It's not because there's anything going wrong with your back. It could be that you have flat feet, right? And that's what gets your
Right.
back
Right. Right.
to
Right.
hurt. But I didn't know
Yeah.
this. for me, it would be like, okay, I got to go look at my back, right? It's the same thing with
Right, right, right,
mortgages, you
right.
know? It's like, I don't know what's hurting or what I need, but it's the professional will know more in terms of like what they can get me and what's best for me, not even just the max amount or lowest rate or whatever, what the complete product, which one is the best for me and my lifestyle. They would know more than I would.
Yeah. Yeah, exactly. It's like we're kind of like matchmakers in that
Yeah.
sense too. Like just trying to take all the raw data in, figuring out sort of okay, well, what is the end goal here? What do you want to achieve, and then structuring it in a way that makes sense for the borrower, but also is in the best light for a lender, so you can get that approval because that's essentially what it comes down to. And yeah, back in my days of like tea shopping and doing the retail thing, um, when I say hand off, I mean more like I don't have the mental capacity to deal. I know what I
Mm.
want, and I know, sort of like this is essentially what I'm trying to do. Help me navigate it. What do you need? And let me know how it's going to pan out. And I've kind of taken that to heart too, because every client that comes across my desk, they're not. It's not cookie cutter. Everyone's got their own story, their own goals, their own challenges and struggles, and literally is sort of like a matchmaker. So you find the right lender that matches with that client's current needs and then future needs. So, yeah, definitely, it's so important to kind of uh, and be completely open and transparent because we're kind of, and this is one of the analogies I've used with it, and I've experienced this too. Like when you go into a bank, and not to knock the mobile mortgage specialists or the bank, the branches. I mean, they serve a purpose and they're good at what they do. But when you are going to a bank rep, what's a bank rep? Bank represent they're representing the bank,
Yeah.
right? Even though they're, hey, come down, let's talk. I want to do business with you. At the end of the day, they're sitting across the table from you, and you're stating your case, and you're like, Mr. Banker, I need money, right? So in our world of brokering, we're kind of like your ally. We're on your side. It's kind of like if you went into a branch to negotiate, we're sitting on the side beside you to say, okay, well, these are the merits. This is the type of client. This is why, um, you're lucky to have them and to have their business. And because we come in as volume players, right? If you walk into a branch and you need a mortgage for 500,000, but we've just placed in the same month 20 million or something with that lender, we have a little bit of negotiating power too. So yeah, it's and I think more than anything, a lot of people focus, and you mentioned this too, Harris, on the back in the day. You used to have just like one rate. We're talking insured or high ratio mortgages. There's so many
Mm.
different products. So it's more so now than ever, so important to make sure that when you're discussing your plan and your strategy, you don't just focus on
Yeah.
the interest rate, because you're missing out on so many things like prepayments or penalties, portability. Being able to access that equity, because I've seen a lot of people in the last couple of years, they realized how much equity they're sitting on. And if you're triggering a penalty and you hadn't anticipated, or you had no idea there was a penalty because, the guy down at the branch just gave you a really good rate. I mean, then it's kind of stifling your ability to make the next move. So
Speaking of
it's all about sort of the
penalties,
mortgage.
within the last week or so, I had a penalty come by our desk, my desk, across my desk, 60 grand. I was like, what the heck? 60 or is it 68? Some obscene number, man. It's like stupid.
How much was the mortgage,
It was
the payout?
sizable. It was sizable. I forget it
Yeah.
was. It was like a mil or two, 1 point something million. But
Yeah.
the thing is what people don't realize is like, yeah, they're going straight to the bank. How many first time home buyers are going to go straight to the house to buy the house? You get a realtor to go
Mm,
represent yourself, right? I haven't seen anyone
right.
kind of go in and self represent. Why? Because you're getting into a contract and you want somebody who's kind of on your side, because why aren't you just kind of going with the seller's realtor? Maybe because they're representing the seller, right?
Yeah.
So I
Yeah.
like same thing. I would argue, and I'm not kind of casting doubt on anyone's professionalism, but the bank reps are selling the bank's products, right? So if you look at it that
Yeah.
way, now you're kind of looking at like um, whose interest is it? They have one interest only, right? Whereas a
Right.
broker is
Yeah.
kind of like, all right, well, if this guy doesn't play ball, I'll go somewhere else. I'm gonna make sure that I find kind of the deal that's right for the client, what's good for them, and sometimes it's not even up to. Feel like it's not the fault of the bank reps, right? Because they can only provide you with the products that the bank has available, right? They don't have If
Right.
they don't have
Yeah.
the product that's available that's the best for you. They don't know what to give you, right? They're gonna give you whatever kind of. Okay, well, if your shoe size is you're like a 9 or a 10, right? And they don't have 9 or a 10, they'll give you a 12. It'll still fit. It'll just be a little loose. You know what I mean? You might be
Yeah. Yeah.
tripping on
Yeah. Yeah.
yourself here and
Yeah.
there, right? Tie those shoelaces real tight, but it'll fit. You know what I mean? So that's what they're kind of doing. So you want the right size shoe so you can run the fastest you can.
Yeah. I love the analogies we've just been like throwing out there today. It's been all over the map. It's good though. Uh, so this actually it reminds me of a file that I had. And typically people are signing up for a 5-year term, right? That's the most
Yeah.
common is to do a 5-year term. So I had a client back in 2016. So we're coming up on 5 years last year. Came to me and he's like, "Hey, actually, no, no, no. This was he had broke the mortgage early, and it was with a credit union.
Mm,
And I don't knock credit. I love credit unions. They're great. Um, they're very specific. So depending on a client, if let's say, for example, uh, you've got a client that's in the military, well, chances are they may move outside the province. Credit union, because they're provincially regulated, they might not be in that province. Maybe not a good fit. For this client, though, perfect fit, great rate, good product. And fast forward, he's like, "Hey, Dan, I'm looking to move into another town, and we need to sell our place, break the mortgage." Okay, no problem. So we run through his affordability, finds a new place. Um, and actually, sorry, he was doing an equity takeout. So he wasn't selling the old place, he was just
mm,
refinancing it, right, to pull some money up. But the penalty, so he calls the credit union, and the penalty they quoted was, let's say it was, I don't know, $3,000. So you incorporate that when we're doing the analysis to make sure,
mm,
okay, does this make sense? And then come time to actually uh, get the refinance, which was only like a week later, we ordered the discharge statement, and the penalty went from like 3 grand to $12,500. Massive change. And not to fault anyone on this, but the credit union did change. I believe it was the posted rate. So the calculation on a fixed rate penalty coincides with that change in the posted rate. So it increased the amount of penalty for the client. Anyway, just to touch on your whole like bank representative working with your branch, he could have easily walked in a few years ago, gone to that credit union, gotten the same mortgage, right?
mm,
And wouldn't even know that I existed. But he would have likely done the same thing where he was taking money out, and he would have paid, instead of $3,000 to 12,500. But because I had seen that, and we had enough documentation, and because of my relationship with the lender, we escalated this, and I made the case. We stood our ground on it, and at the end of the day, I think the credit union decided that they were in the wrong in how they represented it, and they honored the old penalty. And that's something where, I mean, he was ecstatic because if he was to go ahead and just go into the branch, I don't think he would have fought for it. I think he would have just accepted
mm,
it, or maybe not even have done the
mm.
refi and been able to buy, the properties in. So, the value of working with a broker, and I'm not trying to, um, you know, but anyway, the
No, no, I
value of
can
working with a
attest to
broker
that.
is definitely
I've
there.
seen that several times. I've seen that actually
Yeah.
enough times where if you're going to a bank rep, the bank rep's not going to like look at your, especially if you're refinancing. they're not going to look at the discharge statement. And I've seen strong brokers, right, like go in and negotiate and be like, no, the discharge statement, like
Right.
if it changes, because I've seen a
Yeah.
huge fluctuation, because especially over the past few years, right, like interest rates constantly been dropping. The differential keeps going up. So then it's like a lot of money. And
Yeah.
a bankrupt's not a bank rep is never not necessarily going to go. I mean, not necessarily, they never do, because that's not part of their job. With the brokers, it's they can just go in and talk to all these banks, because chances are that that broker, it may be repositioning your mortgage with that credit line now, but they are giving that credit line or credit union, sorry, business as well. So
Right. Right.
you're
Right. Yeah.
leveraging that relationship.
Exactly. And they look at it as sort of holistically and they say, okay, you win some, you lose
Yeah,
some sort of thing. But overall, it's a great partnership here and we want to continue doing business. So it makes sense. Yeah, 100%. And for anyone that's listening on this and you're kind of confused, like you're probably going to be confused on
yeah,
what IRD penalties and discharge statements, essentially anytime that you're making a change to a mortgage. So this wouldn't happen when you're just buying a property, but down the road, let's say you want to make a change and you signed on a 5-year agreement for a mortgage term. If you break it before the 5 years is up, that's going to trigger a
yeah.
penalty. And that penalty, when you get to the lawyer's office to break the mortgage, they request you guys request a what's it called,
The
payout
discharge
payout
statement.
statement,
Yeah,
discharge statement. And that discharge statement basically states from the bank what that penalty is going to be. So that's basically what a discharge statement is. Anyone doing first time home buying, you don't have to worry about that right now, but keep in mind that yeah, there are penalties out there that are built into every mortgage.
yeah.
So
I mean,
we've touched on,
yeah. What are you gonna say?
I was just going to say, so we've already touched on sort of the first 6 months out, getting pre-positioned or getting pre-approved on it. I guess the other question is, as far as what you do in the capacity of first-time home buyers, you're the legal representation. Do you want to touch a little bit on that? Like, what are people to expect in this scenario? What's your role in all of it as
So
a lawyer?
when you're buying a house, and you've when you come to us, you typically have an agreement of purchase and sale. Sometimes you're coming to us and you need a status certificate review. So we're working with the brokers, we're working with the realtors and the mortgage brokers. We get the status certificate, we review it. In fact, I've got some to review today as well after this podcast. But
Yeah.
we review it to make sure that legally there's no red flags. And then once you go firm, we will do a title search on your property to make sure that your title, when the seller hands it over, is clean. And then we will be working with the seller's law firm to ensure that everything works out, and if there's anything on title that shouldn't be, it should be taken off. If there's any mortgages we make on the title, that which is perfectly normal if the seller has a mortgage, we make sure that we get the right documentation and ensure that it's all paid off through the right channels,
Right.
right? So we have channels that we use. So we never, for example, we would never let the seller's lawyer give the money to their client and have them pay off the mortgage. We always have the seller's lawyer guarantee that the law firm, is going to pay it off, and they're kind of responsible, all that stuff. So we take care of all of that. One of the biggest things, though, I think that first-time home buyers especially don't realize is land transfer tax. So land transfer tax
Mm,
is expensive. Um, and it's a significant. It's probably the biggest portion that you have to kind of pay for. It's not part of your mortgage, right? So typically, you're paying
right.
for your legal fees, your land transfer tax, and any kind of disbursements to put everything together when you're buying the house. So the land transfer tax, if you're a first-time home buyer, it's if you're outside of Toronto, you get 50% off up to a max of 4,000. And I believe if you're buying within Toronto, well, if you're outside of Toronto, you get the provincial land transfer tax. So if first time home buyers, 50% off up to a maximum of 4,000. If you're buying within Toronto, you have two land transfer tax, which is what people should remember. You have the provincial one, and you have the city one. The city of Toronto municipal land transfer tax. So you have two land transfer taxes, essentially double Toronto land transfer tax.
So it's the same percentage, like the
It's
the provincial and the
it's the
municipal.
same percentage, but for first time home
Wow.
buyers, I believe land transfer tax for Toronto is 50% without the cap. So I gotta check on that, but it doesn't have a cap of 4,000.
Right.
So
Right.
so it doesn't mean that you're not paying anything. It is sizable. So I would definitely like when you have first time home buyers looking at that, they do go through sticker shock in the beginning. They're like, whoa, what is this? So be prepared for
Yeah.
that. So that's your biggest kind of for a purchase. It's your biggest out of pocket expense.
Right. And I think, and like I'll see on a lot of commitments. So when clients come to us, they found a property, they put the offer in. We need the lender now. Now we're doing the pairing, and we have sort of a deadline to get that approval. Anytime it's high ratio, so less than 20% down, there is always a condition on that mortgage approval that states the buyer must have a minimum of 1.5% of the purchase price set aside for closing costs. And that 1.5% has to come from their own funds. It can't come from like borrowed sources or credit cards or gifted funds or
Yeah.
whatever. It's got to come from your own
Yeah.
pocket. So you don't really see this on conventional purchases. They don't need the confirmation because you're putting 20% down. But yeah, something else to kind of keep an eye on. Do you find that 1.5% typically covers in Toronto when you include a double tax land transfer tax? Does that cover it?
I wouldn't know off the top of my head,
Yeah,
but
yeah. But regardless, those closing costs definitely add up. And I've heard people too, like call me up and say, "Oh my God, like, I didn't know it was going to be so expensive to close on it." And I mean, these are all. I feel like as lawyers, you guys, you do a heck of a lot of work, and you don't charge as much. And to me, I look at it and I'm like, okay, you know what? For the cost of the legal representation, for you guys to review documents like status certificates, to discharge anything, to make sure that the title is clean. You are legally representing people in a capacity and a purchase that is, like I said, the largest purchase they've likely made to date. It's not that expensive, but the one thing I've noticed, and not to knock in any other law firm and whatnot, but sometimes I'll see buried in it, like they'll have a really low sort of like, hey, um, and it's the same thing as when people send to me like, oh wow, I got this email with an interest rate that's like killer. Well, you also get email blasts where it's like 4.99 closing costs,
yes,
right? But then that doesn't include things like what your title insurance or there's a whole bunch of things that you guys
yeah,
have to pay for as lawyers that add into that, or like if things have to be discharged or paid out, there's costs, there's wire
yeah.
fee costs and everything else, right, built in. I just feel like it's, I oftentimes I'm doing I'm trying to explain to people, especially first time home buyers, that, hey, you know what, you kind of get what you pay for, but you also, there's a lot of hidden things here. So you want to have full transparency on
I think the
closing.
biggest misconception, I mean, it's not a misconception. What ends up happening is when you're working, when you're buying, you're stressed out, fair enough, but you're seeing what
Mm,
the realtor's doing, right? They're bringing you to different houses, they're doing all of that. You're seeing what the mortgage brokers kind of, to some extent, doing because they're asking you questions and all of that stuff. Our stuff requires little input from the client. In fact, unfortunately, the only time the client gets a call from me is when something's going wrong. If it's going
right.
right, then they don't get a call from me because we're doing title search, and that takes experience. It takes expertise to go through the title and make sure we're requisitioning the right things and making sure that the money's flowing the right way, making sure we're getting the right warranties from the sellers, making sure the documents and everything line up. It takes experience, but we don't need input from the buyer. We just need the buyer's like address, their phone number, IDs, kind of like that. And then if something goes wrong, then we kind of have to have that conversation with them. So often enough, because they're not seeing us, they feel like we're not doing the work, and it's
Yeah.
difficult for us, to at the same time kind of show them what we're doing. But really, I mean, like again, like if you want to add 10 years of experience on top of 3 years of law school, then and in like 5 minutes is going to be difficult. I can't really explain
Yeah.
like in depth why I'm doing certain things. I just know I have to do them because there's like it's contingent or dependent on like 20 other things that I have to deal with, and if I'm gonna start explaining all that to you, then I'd have to charge you hourly. It's gonna get expensive.
Yeah. Yeah. No, no, thank you, Your Honor. I'm not, not today. Um,
Yeah.
yeah. Anyway, so I know there's a lot to unpackage for first-time home buyers, and the process can seem pretty overwhelming because there's other things too, right? You gotta plan. Okay, well, um, start packing stuff up, movers, getting your utilities and everything sorted out at the new property. Um, Tons of things involved when it comes to buying a property for the first time. So I think if anything, the key takeaway here is just, hire the right people that are representing you and try to take as much off your plate as you possibly can when it comes to, the stress of all of it. But at the same time, too, you want to be um, educated in the buyer process. And I feel like, honestly, I'm obviously I'm a mortgage broker here,
Yeah.
Harris, but what I really pride myself on is being able to educate people as they kind of go down this journey. And I know you're exactly the same
Yeah.
way too, right? Like you spend your time, you take your time walking people through everything. Like so it's I think it's so important because the more you understand, the more and I always encourage people to ask questions, as many questions as you possibly can, because it's the only way you're going to get the answers. So um, yeah, I think that pretty much, at least for me, wraps it up.
Yeah. No, I think that was a good episode. I mean, again, there's so much. We've just touched the tip of the iceberg. If you've got questions, they're more than welcome to reach out to us, and we'd be
For
happy to
sure.
answer them. But again, we've just kind of touched the tip of the iceberg, right? And it's like we see this every
Yeah.
day, and I speak about you and me both. Even though we see this every day, it's not even just that we see it; we're immersed in it. So we're constantly learning about it. We're constantly kind of updating our facts based on everything that's going on. So that's the other thing, right?
Right.
Like a lot of people will be first time homebuyers jumping into it, right? They'll say, okay, well, I read this article. Well, when was that article? You don't know if it's dated or not, if there's any changes, and it's difficult to kind of wrap your head around it, especially when you're jumping into it and realize, okay, this is the progression. We know the progression because we're living the progression. So
Right. Yeah. 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 We're as relevant
yeah.
as can be right now. So it's yeah, it was good. It was a good conversation today. Thank you again, Harris, for setting this up for us, and looking forward to the next Tuesday talk,
All right, man.
which will be next
Yeah.
Tuesday.
Thanks, guys, for joining us. See you next time.
Yeah. All right, guys. Take care.